Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for September 10th, 2017. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.09 fell from 1.17 last week, declining yet remaining within bullish territory. The total count of securities in bullish or bearish patterns increased 1% to 2,916. The count of bearish stocks increased 5%, while the count of stocks in bullish patterns decreased 2%. The Pirls PNF market breadth summary chart shows us a market now 2 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the Pirls Stock Market Commentary via email, free of charge, simply enter your name and email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 103 points for the 12th advance in 20 weeks. At a negative 60.38 points, it continues below the 6 tops above plus 100, has risen above the April 2017 bottom, and continues above all 4 remaining bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 6 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. On Thursday, 9/7, the CCI 20 had 6 days above zero to begin a Woody's uptrend. The CCI 20 daily is now at a positive 59.94, down from a positive 155.92 last week. We wait for the CCI 20 daily to return to the plus or minus 50 range for a zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 71 weeks ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly has fallen to a positive 108.90, down slightly from a positive 109.99 last week when it formed a zero-line reject long entry signal for Tuesday 9/5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will follow the result of this trade simulation in next week's commentary. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: S&P Retail, Oil Services, and Gold and Silver on top. KBW Bank, Brokers, and some Tech on the bottom. Bullish: S&P Retail has entered the top 5. REITs has left the bottom 5. Bearish: KBW Bank continues in and now leads the bottom 5. Networkers continues in the bottom 5. Gold and silver continues to lead the top 5. Disk drives and semis have left the top 5. Focus this week from www.realinvestmentadvice.com. Signs, signs, everywhere a sign. From September 8, 2017. By Lance Roberts. You don't have to look very hard to see a rising number of signs that suggest the Trump trade has come to its inevitable conclusion. Following the election, this past November, the financial markets rallied sharply on the hopes of major policy reforms and legislative agenda coming out of Washington. 11 months later, the markets are still waiting as the administration has remained primarily embroiled in Washington politics with a divisive Republican-controlled House and Senate. While there are still hopes the administration will pass through tax reform, the failure to rally the troops to repeal the Affordable Care Act leaves permanent tax cuts an unlikely outcome. That hopeful outcome was further exacerbated with the deal cut between President Trump and leading Democrats to lift the debt ceiling and fund the government through December. That deal has effectively nullified any leverage the Republicans had to strong-arm a deal on taxes later this year. The markets are figuring it out as well. If you want to know where the economy is headed over the next few months, you don't have to look much further than interest rates. Since interest rates are ultimately driven by the demand for credit, and that demand is driven by economic growth, their historical correlation is no surprise. But like I said, if you want to know where GDP is going to be in the months ahead, keep a close watch on rates. I suspect before year end, we will see rates below 2%. As a reminder, this is why we have remained rampant bond bulls since 2013, despite the continuing calls for the end of the bond bull market. The 3 Ds, demographics, deflation, and debt, ensure that rates will remain low and go lower in the years to come. Think Japan. Like rates, inflation is also closely tied to the direction and trend of economic strength. While the Fed continues to hope for a return of inflationary pressures, the real strength of the underlying economy suggests something quite different. But there is no better sign to watch than that of the US dollar. The dollar is the representation of the world's belief in the strength of the US economy. A stronger economy attracts capital and investment, which drives the dollar higher and further boosts economic growth. The opposite also applies. The recent decline in the dollar, which is likely to continue, suggests that economic growth will weaken in the months ahead. While it is not hard to see or understand the correlation between these individual signs and the direction of the economy, we can see it even more clearly by building a simple composite. The composite below is the dollar, interest rates, and inflation as compared to nominal GDP. Currently, the composite index has turned down rather sharply, and we should expect economic growth to track along with it in the coming months. All of these signs are worthy of being watched closely. A weaker economy leads to weaker earnings growth, and estimates are already under rather severe downward pressure. Given the overvaluation of the market and hopes of legislative agenda beginning to fade, there is a significant risk to outlooks for the market in the months ahead. The last few times the dollar, rates, and inflation fell following a previous advance, the outcome for investors was not all that great. However, as I said above, we are indeed moving forward, but with caution. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.